Well, hello everyone, and welcome to the weekly Wednesday webinar brought to you by Alternative Design. This is Tim Harding. I'm the Chief Marketing Officer for Alternative Design, and good to be back after a couple of weeks of not broadcasting, but we're back on regular schedule now, and we'll be back once again a week from today as well. Today's topic, one that I'm pretty excited about, because when we first got this particular certificate of deposit and it was made available to us, I thought it really fit well into our overall portfolio. And I think once you get familiar with it, you're going to see that there are a lot of terrific uses for the J.P. Morgan High Yield Bond Certificate of Deposit. So we're going to do something that we don't do a whole lot of on these weekly webinars today. We're going to take a little bit more technical look at a product. We always emphasize trying to keep things simple and straightforward with your clients and prospects. I mean, after all, at the end of the day, no matter what the bells and whistles on these things are, it's still just a certificate of deposit. It's a principal protected and guaranteed FDIC insured product, and that's really the main story. All the other stuff is just window dressing. But today, we're going to pop the hood. We're going to take apart the engine and take a little bit closer look at this particular CD, because I think once you get to know it, you're going to find that there are lots and lots and lots of uses for this product, and it's going to give you the ability to do some things that you really never had before. And I think you're going to like its applications. As always, I will hold the questions until the end of the presentation. If you have a question at any time during the course of today's webinar, please feel free to go ahead and type it into the chat box on your control panel. And as always, at the end of the program today, I will pull those questions up and respond to as many of them as I possibly can. So once again, today's topic is the new to us J.P. Morgan High Yield Bond Certificate of Deposit. And one of the reasons I'm so excited about this particular CD is that the timing is perfect. I've cited this particular article before, but there have been 4 or 5 others as well, all indicating the same thing, that investors are moving from other options into the high-yield bond marketplace. And in fact, the past year for high-yield bonds was one of the best in a very long time. The good news is not to worry. There's still plenty of room for growth in high-yield bonds at this point, and that's why a lot of the smart money has been moving in that direction. Now, historically, if you were going to be an investor, the first place you would look would be to equities or to stocks. But in order to counterbalance that to whatever extent was appropriate given your stage in life, it was always recommended that you mix in some bonds as well. And this is primarily because stocks and bonds have historically tended to have an inverse correlation to each other. They kind of balance out a portfolio. And besides all of that, we know for a fact that asset allocation in any portfolio is the key determining factor in how that portfolio performs over time. So it's important to have a diversified set of asset classes within any investment strategy. But we're not talking about high-grade investment-grade corporate bonds here. We're not talking about government bonds. We're talking about something completely different here. We're talking about a high-yield bond. And so before we get started, we really have to understand what that means. The reason there's a high yield or a higher interest rate paid on this particular class of bonds is because the creditworthiness of the corporations issuing the bonds is not at the top level. In fact, high-yield bonds are frequently referred to as junk bonds. Well, that right there should send up a red flag and say, danger, danger. And in fact, high-yield bonds are riskier than the higher-grade investment-grade bonds. But if you could have exposure to the higher yields, if you can have exposure to those higher interest payments without having your principal at risk, without having to worry about whether the borrower defaulted or not, without having to worry about interest rate risk. And all of this was wrapped in an FDIC-insured package. Well, it makes having exposure to high-yield corporate bonds much, much more attractive. Now, from a technical standpoint, this is where we get into the high-yield category. You'll notice that ratings from Moody's of AAA and S&P of AAA all the way down to A, those are all investment grade, including BBB. Anything below a BBB rating, whether it's Moody's or Standard & Poor's, falls into the category of junk bonds or high-yield bonds. And you can see by taking a look at this chart on the far right-hand column where it's talking about risk, you're going to see that the higher risk falls into that junk bond category. But investors are still attracted to these higher risk bonds because in exchange for taking more risk, they're going to get a higher yield than they could get in those investment grade bonds. The good news is that we have a product here that can give your clients exposure to those riskier investments without putting their principal at risk. And when you look at how the particular index in this market-linked CD works, you're going to feel even better about your ability to give exposure to your clients in this particular asset class. The product itself, of course, is from JP Morgan. It is a 7-year, what's called a variable income certificate of deposit. It comes with a minimum annual interest guarantee of 1%. So let's start right there because this is an important point. In no year would your client ever receive 0 interest, even if the performance of the underlying index here is poor. Worst case scenario, they're going to get roughly the equivalent of what they could get in a 5-year traditional jumbo CD. Okay, so let's start with square one. Your client's guaranteed a minimum interest payment of 1% annually. This product is linked to a proprietary index called the JP Morgan High Yield ETF Volatility 3% Index. So it's a proprietary index created and managed by JP Morgan. The High Yield ETF Volatility 3% Index. Now, that volatility 3% is an important factor of the way this index works, and one of the key reasons why I think this is going to be a really, really attractive deal for your clients and prospects. And of course, this product has no cap. No cap. The JP Morgan Index is driven by the PIMCO 0 to 5 year High Yield Corporate Bond Index ETF, or Exchange Traded Fund. So what you have here is JP Morgan has created an index that reacts to the performance of this particular exchange traded fund, this PIMCO ETF. Now, this particular ETF is the only ETF that is designed to capture continuous exposure to the short maturity segment of the high yield corporate bond sector. The only one. And as of March 2014, the index is composed of roughly 352 holdings in the high yield bond sector, with maturities ranging from 1 to 5 years, with an effective maturity of 2.81 years and an effective duration of 1.93 years. Now, this is important because as we know, if you own bonds and interest rates go up, well, the value of your bonds could go down. The important thing to understand here is that you have a portfolio of varying maturity dates, so that if there is a change in interest rates, and there will be, the maturities on the bonds held in this ETF are close enough that the fund will be able to hold on to them until maturity and therefore retain principal. They won't have to liquidate them at a discount. So nicely structured ETF The JP Morgan index, to which the CD is linked, follows this ETF, but it follows it in a very, very specific way. It has a 3% volatility control mechanism attached to it. The way this works is really quite simple when you think about it. Since it's a 3% volatility target, as long as the volatility in the underlying PIMCO ETF is 3% or less, the index, the JP Morgan index, reflects 100% participation in the index. However, if something happens to cause volatility, interest rates change, there's a spike in interest rates or something along those lines, and the volatility, the actual volatility of the ETF goes up beyond 3%, then the JP Morgan index reduces its exposure to the index, softening the blow, and moves a corresponding amount into cash equivalents. In other words, there's a rebalancing in the event that something happens to move the underlying ETF drastically one way or the other. So this is really, once again, as is typical with the market-linked CD indices, a dynamic index, an index that adjusts to changing conditions. You know, I've spoken several times before about how, as wonderful as, the S&P 500 index is, you really got your raft on the river and you're going with the currents no matter what happens. With the indices created by and for market-linked CDs, you often see a dynamic factor where the index can respond quickly to changes in economic conditions. And this volatility control is another one of those dynamic features where the index increases or decreases its exposure to the underlying PIMCO ETF depending on how volatile the market is. What this does is when there is a significant move in the market, since the index has less exposure than the ETF's value will in all likelihood drop far more than the index will drop. In other words, it's like a safety net, a buffer. Now, there's another side of that sword, another edge of the sword, and that is that if there's a sudden spike up in volatility, it's unlikely that the index would capture all of that spike. But the result is a return that tends to stay fairly consistent over time and doesn't jump all around the place. Now, remember the trigger point is 3% volatility. But if you look back historically, all the way back to January of 2007, you will see from this chart that the vast majority of the time, the volatility of this particular ETF was below 3%, which means that the index would have been 100% invested in the index for the vast majority of this time frame, from January of 07 to January of 2014. You'll notice it would have missed out on some of these big spikes, both directions, but would have maintained a consistent return. Now, here's another important feature to keep in mind. Please note that the return on the ETF, the PIMCO ETF, is calculated on a total return basis. That means that the dividends that are received by the ETF are reinvested in it. Now, this is important because the dividend on these high-yield bonds is significant. As of March of 2014, it was 4.49%. And therefore, you can see, as illustrated by this chart, the total return on this ETF is going to be higher than just the price return because it's going to continue to grow as those dividends are reinvested. Now, We all like historicals, and one of the disappointments that I know many of you have in the field about the MarketLink CDs is many of them cannot be back-tested historically. The good news with this product is that it can be back-tested. You can go back and look at historical, hypothetical performance as well as actual performance. And you can see that by this chart, it's pretty much right where it should be. Earning better than the Barclays Aggregate Bond Index, not quite as high as the actual ETF itself, but with far less volatility. You'll notice it has a rather steady growth pattern, a rather steady growth line from 2011 through 2014. So we expect very, very good performance out of this CD starting early on. There's a very interesting thing, I've talked about this a number of times with banks, and that is that they don't like volatility. And as a consequence, when they choose a stock portfolio, or they choose stocks for the basket that they're going to link their CDs to, they have a very, very strong inclination to choose large cap value stocks. That means stocks that are underperforming. They're bargains. They're undervalued right now. Well, they don't turn around and start regaining that value the moment a CD is created, but they're expected to over the duration of the CD. So there's a gradual increase in the interest paid on the MarketLink CDs that are linked to stocks. Conversely, we expect this particular product to come out of the box pretty fast with a very decent return in the first year. I tip you off to this because in putting together a portfolio of CDs for your clients, mixing a stock link and a bond link could make a whole lot of sense to your client's circumstances. Now, this product calculates the annual interest rate in a way that may be new to many of you. So I did want to take just a moment to go through how the calculation works. It may sound complicated at first, but walk through it. It really isn't a complicated formula. It's really pretty straightforward. First of all, remember that with virtually all of the MarketLink CDs, we're always referring back to the initial share price or the initial index price on the day the CD closed. This product is no different. We don't go year to year. There is no annual reset. We are always looking back to that initial index level and comparing that on the anniversary date with the index level on the anniversary rate. So the way this works is this. This is an example right out of the disclosure documents, and there are several examples in the preliminary disclosure documents, so you'll be able to go through and take a look at these. So on the left-hand column, you see it says coupon determination date. That would be at the end of the first year. And so in this hypothetical, there was a 4% growth from the initial date to the calculation date. Okay, so the index is up by 4%. We are ending the first year, so we're going to divide that return by the number of years. So 4% divided by the index factor of 1 year is 4%. So in this first year, in this hypothetical, the interest rate paid, the coupon, would be 4%. The second year, once again, we go back to the initial index price, the initial index level, and we see that at the end of the second year, the cumulative index return is 8%. So over 2 years, it's gone up a total of 8%. That would be 4% a year. But it's at the end of the second year, so we're going to divide that 8% by the number of years, in other words, 2. And so 8% divided by 2 is 4%. The interest payment that year in this hypothetical would once again be 4%. into the third year, on the anniversary date, we look back again, and from the initial date to the third year anniversary date, the cumulative return is 12%. Divided by the number of years 3, once again a 4% interest payment. In the fourth year, in this hypothetical, the index went backwards. So from the initial price to the end of the fourth year price, there's only a 7% total cumulative return. We would divide the 7% by the number of years, in this case 4, and so the return for that year would have been 1.75%, and the coupon payment, the interest payment, would have been 1.75% for that year. Once again, in the fifth year, we lose again, and the difference between the initial price and the current price at the end of the fifth year is only 2%, divided by the number of years, 5. The cumulative return would be 0.40%. That's below the minimum guaranteed return of 1%, and so the client would receive the 1% minimum guarantee. And you can see the same thing happening in the sixth and seventh years here. So a little bit different than many of us are used to seeing, but really quite simple. You take the return point to point and divide it by the number of years, and that's the calculation for the interest payment at the end of that year. Now, the really exciting thing to me about this particular product is, for the first time, you can really do an asset allocation strategy with your clients in an FDIC insured and protected environment. You now have the ability to mix a portfolio of stocks, bonds, and commodities together to achieve your client's goals and objectives. Now think about this. This is almost like assets under management, except without risk to principal. If you think big enough, I can see a day coming when this will be just about the only sensible way to invest. Because why would you invest directly in commodities? Why would you invest directly in high-yield bonds? Why would you invest directly in stocks when you could get some upside exposure to all of those asset classes, but without the downside risk and with the added security of FDIC insurance? Some huge, huge possibilities with the mix of products that we now have on our platform. Now, we are at that point. We are at the end of the month, and as you know, we've got Chris Gross bouncing off the walls here, trying to get everything traded in time so that you get paid on cases that you've submitted. For those of you who are working on cases right now, time is of the essence. The cutoff dates are, well, too late for the Bank of the West commodities product. The cutoff time has already come and gone on that. That was today. So no more commodities products available for the month of April. Tomorrow, the Goldman Sachs 8-year product and the Bank of the West Equity Income Advantage product will cut off. That's at 1 p.m. Eastern Time. That's Eastern Time. And then this JP Morgan product and the Bank of the West Morningstar Ultimate Stock Pickers product both cut off on Friday at 1 p.m. Eastern Time. So you still have a little bit of time to get that last piece of business in particular with the Goldman Sachs and JP Morgan and the Morningstar product. So if you're working on something right now, please call your business consultant. Let them know that you've got a case that's pending. They'll do everything they can to help you, as will Chris, to get your case processed and traded on time. We want to get you paid as quickly as possible. And so if you've got business to get in, very little time left, but we'll do everything we can to help you. So with that, at this point, I will be happy to go ahead and take questions from any of you on this topic or any others. But I think once you start looking at this product, you're going to be at least half as excited about it as I am, because I can just see application after application for this product, and I think it's going to show some very nice returns, especially when combined with some of the other offerings that we bring you every month. So I will pause for a moment here and see if there are any questions, and if not, then we will move on and look forward to chatting with you next week. Not seeing any questions at this point. Okay, got one here finally from Richard. Is there a history of this product or index? The answer, Richard, is yes. It can be back tested, so you will find historical performances, both actual and hypothetical, going back at least 10 years. So you can sell this product off of the back testing. That's unusual for most CDs, but this one is conducive to that, so it is available. Question from Mark, can we count on this product being available for quite a few months? Mark, we can't count on anything with the banks. I can only tell you that it is our expectation that this product will be available for 7 months, or several months, and into the foreseeable future. We do not anticipate a significant change in it or that it will be pulled. Having said that, we're still at the mercy of the banks on these things, and if they decide to change things, they will, and let us know about it usually at the last minute. But we will certainly keep you informed whenever we learn something. Okay, it looks like that's it up to this point. So once again, I want to thank you for joining us today. We appreciate you taking the time to spend with us and learn about this new product. Look forward to being back with you next week for the regular Wednesday webinar, same time, same place, 11:35 Pacific time. Until then, have a great week.